The S&P 500, what it tells us about the U.S. market and valuations today. Welcome back to the channel. Today we're analyzing the S&P 500, the most watched stock market index in the world. Whether you're new to investing or already tracking the markets, understanding what this index represents and what it can tell us about the economy, valuations, and future returns is essential. By the end of this video, you'll know what the S&P 500 actually measures, how its composition shapes performance, why current valuations matter, and what history can teach us about long-term returns. Disclaimer: this is general information only and not financial advice. For personal guidance, please talk to a licensed professional. What is the S&P 500? Let's start with the basics. The S&P 500, short for the Standard & Poor's 500 Index, tracks the performance of roughly 500 of the largest publicly traded U.S. companies. It's market capitalization weighted, meaning the bigger a company's market value, the more influence it has on the index. That's why companies like Apple, Microsoft, Nvidia, Amazon, and Alphabet hold enormous sway. Together, the top 10 names make up nearly 40% of the entire index. The S&P 500 covers about 80% of the U.S. stock market's total value. When analysts say the market was up today, they usually mean the S&P 500. What drives the S&P 500? So what drives its movements? In short, corporate earnings, interest rates, and investor expectations. When companies report strong earnings, the index tends to rise. When the Federal Reserve cuts rates, borrowing becomes cheaper and valuations often expand. But when inflation climbs or rates rise, investors reassess, and that can compress valuations. Because the S&P 500 is weighted so heavily toward large technology and growth stocks, these companies can pull the entire index higher or drag it lower. In 2025, for instance, the S&P 500 traded around the 6,800 to 7,000 level, near record highs, largely powered by tech giants and the ongoing boom in artificial intelligence. Key metrics, valuations, and yields. Now let's talk numbers. The forward price-to-earnings ratio, or forward PE, measures how much investors are willing to pay for next year's expected earnings. As of late 2025, the S&P 500's forward P/E sits near 23 times. To put that in context, the 5-year average is about 19.9 and the 10-year average about 18.6. So the current market is trading above average valuations, meaning investors are paying a premium for expected growth. At the same time, the dividend yield, the annual income investors get from dividends, is only about 1.25%. That's relatively low by historical standards, so most of the expected return will need to come from price appreciation, not income. Sector breakdown: who's leading the market? Let's zoom in on the sectors that make up the S&P 500. Technology dominates with roughly 30% weight. Its forward P/E hovers around 25 times, with a yield near 0.8%. Financials hold about 14 to 15%, trading closer to 17 times earnings and yielding around 1.5%. Healthcare contributes roughly 10%, with a forward PE near 17 and a yield around 1.8%. Real estate and utilities are smaller weights but offer higher yields, around 3% or more. This mix matters because sector weighting drives much of the index's risk and return. A tech-heavy market tends to rise fast during growth booms, but can correct sharply if sentiment shifts. The valuation debate. Here's the big question: if valuations are high, should investors worry? Historically, the answer depends on what happens next. When markets are priced richly, say at a forward PE around 23 or higher, future long-term returns tend to be more modest. Research from Oaktree Capital and LPL Research shows that after similar valuation levels in the past, 10-year annual returns average somewhere between 0 and 2% per year in real terms. That doesn't mean a crash is coming. It just means that the starting point matters. When prices are already high, there's less margin of safety if earnings growth slows. Conversely, if corporate profits keep expanding and economic growth remains healthy, the index can still perform well. Lessons from history. Let's zoom out even further. Over the past century, the S&P 500 has delivered about 10 to 11% per year on average, including dividends. But that long-term number hides big swings. During the 1990s tech boom, valuations soared to record highs, followed by a painful correction in 2000. During the Great Financial Crisis, the index dropped more than 50%, then more than tripled over the next decade. The lesson? Time horizon and discipline matter far more than short-term timing. High valuations may cap future returns, but staying invested through cycles has historically rewarded patient investors, especially those reinvesting dividends over time. Key factors to watch ahead. So what should you watch if you follow the S&P 500 today? Corporate earnings. These are the lifeblood of valuations. If earnings forecasts hold up, elevated prices can remain justified. Federal Reserve policy. Rate cuts tend to lift valuations. Rate hikes often compress them. Sector shifts. If leadership moves away from mega-cap tech, the index's growth profile could change. Economic indicators. GDP growth, unemployment, and inflation directly shape investor sentiment. In short, the S&P 500 reflects the collective judgment of millions of investors and their expectations for the future. Finally, to wrap up, the S&P 500 remains the world's benchmark for large-cap U.S. equities. Its strength lies in its diversity, resilience, and ability to capture the pulse of the economy. But remember, high valuations mean high expectations. If growth continues, those expectations may be met. If not, returns could be more muted. Either way, understanding how the index works and what drives it is one of the best tools any investor can have. Again, this is general information only and not financial advice. For personal guidance, please consult a licensed professional. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and share this video with someone interested in markets and investing.